Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Wednesday, March 4th, 2026, and we're excited to bring you the latest AI-generated insights from yesterday's market buzz.
That's right. Our algorithm sifted through a significant amount of social media discussions and market commentary collected on Tuesday, March 3rd. We saw a decent number of stocks flagged, spanning various sectors.
And while there are always areas of concern, the overall sentiment is a fascinating mix. We've got some companies facing real headwinds, but also a few showing promising growth potential that's definitely worth a closer look.
Let's jump right in then. First up, we're talking about Paramount Skydance Corporation, or PSKY. Now, this one has been a roller coaster for our analysis, hasn't it? It was a stay away for a while, then a cautious buy recently, but the latest data has pushed it back.
Yeah, PSKY's definitely been in the headlines. The buzz around its proposed acquisition of Warner Bros. Discovery has really driven a lot of discussion. From a growth perspective, combining such media powerhouses could theoretically create massive synergies and a dominant market position. There's chatter about potential FCC approval, which suggests the deal is moving forward, and Guggenheim even nudged their price target up a bit. Plus, we've seen some insider buying recently, which, always signals confidence from those closest to the company.
Hold on, Ethan. While those headlines might sound good on the surface, the numbers are screaming caution. The overwhelming sentiment among users is highly bearish, and for good reason. Their debt has just been downgraded to junk status following this Warner Bros. Deal. We're talking about taking on an enormous additional $111 billion in debt, adding to an already high existing debt for a company with a market valuation of just $15 billion. That's a debt-to-equity ratio of 117.11, astronomically high.
I hear you, Brooke. The debt load is a serious consideration.
It's more than a consideration, it's a critical red flag. Their net profit margin is a negative 0.021, and earnings per share is a dismal 0.03. Users are pointing out billions in negative net earnings for years, and this new debt means even more servicing costs. The stock is already closer to its 52-week low. While insiders might be buying, the overall financial health suggests this merger is exacerbating existing problems, not solving them. The market's short-term bump is widely seen as irrational.
So the growth story is overshadowed by the financial burden, especially post-acquisition. Got it.
Absolutely. Our AI-generated insights for PSKY, despite the slight optimism from insider buying and a potential merger, lead us to a clear verdict. For PSKY, it's a stay away. The debt concerns are simply too significant to ignore right now.
All right, moving on to another household name that always generates a lot of discussion, Tesla, TSLA. Our data shows a predominantly bearish sentiment for TSLA this time around.
And I can see why. While Ethan, I'm sure you'll point to their innovative spirit and AI ambitions, the valuation is simply detached from reality. The PE ratio is a staggering 356.75. That's an enormous premium for a company that actually reported negative revenue growth of negative 0.031. Users are openly questioning how that valuation is justified, dismissing future narratives around robotaxis or humanoid robots as premature extrapolation.
Well, Tesla has always been a disruptor. Their long-term vision in AI and robotics, while speculative, does offer significant future upside. The company is actively pursuing these advanced technologies, and if even a fraction of those come to fruition, the revenue growth could explode. We've also seen net insider purchases of over 2.6 million shares in the last 6 months. That's a strong signal of internal confidence, even if the public sentiment is skeptical.
But Ethan, we have to look at the here and now. Negative revenue growth, a massive PE ratio, and a high debt-to-equity ratio of 17.76 highlight substantial financial leverage and risk. The beta is also quite high at 1.92, indicating extreme volatility. The news is full of headlines like Tesla under fire and discussions about significant risks for shareholders. For a company to justify such a valuation, it needs undeniable growth, and the current numbers aren't showing it. The future potential is already priced in and then some.
It's certainly a stock that requires a leap of faith, or at least a very long-term horizon.
Indeed, given the fundamental disconnect between its valuation and current performance metrics, our AI-generated analysis suggests for TSLA it's a stay away. The risks are just too high for the current financial picture.
Next up, we have Micron Technology, MU. Now, this is an interesting one. We're seeing a lot of YOLO comments, high-risk, high-reward plays, with some users talking about riding it to 500 or even 600. Despite some recent pain from drops, there's a strong underlying bullish conviction based on future earnings and long-term recovery. This is a stock where the community is really excited about the upside.
I get the excitement, Ethan, especially when you see those insider purchases. Over 845,000 net shares bought in the last 6 months, representing almost 18% of total insider holdings. That's a very positive sign. And the company does have strong fundamentals, like solid revenue growth at 0.567 and healthy net profit margins. Analysts are even raising price targets on DRAM strength and memory market recovery, with an earnings report due on March 18th that could be a significant catalyst.
Exactly. This sounds like a potential turnaround story, especially with the growth in AI memory demand.
But let's not ignore the immediate challenges. The stock is currently trading significantly below its 52-week high, and the news reports are filled with chip stock sell-off amid a long crisis and supply chain disruption. Its beta is 1.54, meaning it's highly volatile and will feel market downturns more acutely. While the forward PE might be appealing, the current trailing PE is still around 36, which is high and prices in a lot of future growth. And a debt-to-equity ratio of 21.24 is extremely high, amplifying risk if those growth expectations aren't met. So while the community optimism is there, the immediate market conditions and leverage warrant caution.
So the long-term outlook might be strong, but the current volatility and geopolitical risks are headwinds.
Precisely. For MU, despite the bullish sentiment and strong insider buying, our AI-generated analysis leans towards prudence in the near term. For MU, it's a stay away for new investments, at least for now, due to its high-risk profile and market headwinds.
All right, let's wrap up our stock discussions with Netflix, NFLX. This one is looking pretty good. Our data captured a user who made a phenomenal 600% on NFLX calls last week. That kind of return generates a lot of positive buzz, you know? There's an implicit acknowledgement of strong potential here.
And the numbers support that optimism, Ethan. Our AI-generated insights show a net profit margin of over 0.24, which is excellent. Return on equity is also robust, indicating efficient management. Importantly, insider buying activity shows over 759,000 net shares purchased in the last 6 months, a strong vote of confidence from within the company. Plus, the recent JP Morgan upgrades certainly adds to the bullish narrative. While the PE is around 38, strong revenue growth and consistent profitability help justify that valuation.
Yeah, the company is showing solid revenue growth, and there's market chatter about a big March for Netflix. They're clearly navigating the competitive streaming landscape well, and that insider confidence really seals the deal for me. It feels like they're executing their strategy effectively.
Agreed. All signs point to continued positive momentum, and the KPIs reflect a fundamentally strong company. For NFLX, our AI-generated market commentary gives it a buy rating. The strong fundamentals and insider confidence are very compelling.
So to quickly recap our AI-generated insights for today, March 4th, 2026, investigate as buy, Netflix, NFLX, investigate as cautious buy, none, investigate as speculative gamble, Micron Technology Inc., MU.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us on the Daily Hunt for Multibaggers. We appreciate you tuning in.
We'll be back tomorrow with more AI-generated market commentary. Until then, happy hunting.